The recent rally we've witnessed in tech and AI stocks, combined with the tiny bit of optimism we're seeing in the markets of late, probably means that your investment portfolio is looking a lot healthier these days, with more green than the red that we're used to seeing, hopefully. I know for me, my portfolio is looking quite rosy over the last few months, but seems to have just crashed and burned these last few days. Anyway, it's all part of the process as a long-term investor, of course. For those that have only been investing for the last couple of years, 2022 really wasn't the best for stock market returns, with only 13% of UK domiciled funds achieving any positive growth at all that year. That's only 134 out of a total of 794 funds. But regardless of whether the stock market is booming, on a downward trend, or completely volatile and all over the place, it's always worth ensuring that our investments are working as hard for us as possible, especially at the moment as high inflation still nips away at the purchasing power of our money and interest rates continue to soar. You might hold your investments in a general investment account or in a tax-sheltered account like an ISA or a Roth IRA in the US. It doesn't really matter. What does matter is that we try and practice good account management to help our investments reach their full potential as and when the markets start to rally more long term. If you're able to prepare and organize your investments in such a way that will allow you to capitalize on any future opportunities, then it really is a surefire way to increase your gains in the stock market and essentially make more money. Whether you're reviewing one of your general investment accounts, looking at an ISA from a previous year, or if you're just considering a new investment at the end of the tax year, let's have a look at 8 quick and easy things you can do to boost your investments over the long term. Method number 1 is regular investing. In more volatile or choppy market conditions, investing in a lump sum can be a risky strategy, given the likelihood of further falls coming in the weeks or months ahead. Instead, why not put as much as you can afford into your investing account or ISA as cash, and then set up regular investment plans to drip feed into your chosen funds or stocks over time. This is what we know as dollar or pound cost averaging into the market, where instead of buying shares at a single price point with your lump sum, you dollar cost average in by purchasing small amounts at regular intervals, regardless of what the price is actually doing. I'll link a video I put together explaining the benefits of dollar cost averaging, so do feel free to take a look at that one in the description below. There are plenty of investment platforms that actually allow you to earn interest on any uninvested cash as well. Or you can just keep the cash in an easy access high interest savings account and manually dollar cost average in at specific intervals if you prefer the more hands-on approach. Either way, your money goes into the market each week or each month, come rain or shine, so you don't have to spend time overthinking or making difficult decisions about when you're going to try and time the market. In months when the market is down, you'll get more shares for your money, and when the market is rising, your money will get you fewer shares. The point is that by dollar cost averaging, you're evening out the highs and lows of the market price fluctuations, which just isn't guaranteed when you invest a lump sum all in one go. Method number 2, be a contrarian investor. Now, this next method for increasing your returns isn't one for the faint-hearted. A contrarian is basically an investor that bucks the trend and purposely goes against popular market trends by selling when other investors are buying and buying when everyone else is just selling. Now, the idea behind it is that markets are prone to herding behavior, which is further exacerbated by fear and greed, making markets periodically over and underpriced. You've likely heard the famous quote, "Be fearful when others are greedy, and greedy when others are fearful," by Warren Buffett. Well, Buffett is probably the world's best example of a contrarian investor. At the height of the 2008 global financial crisis, when the stock market was collapsing, big firms were filing for bankruptcy, and investors were frozen with fear, Buffett advised investors to buy American stocks, including shares in the investment bank JP Morgan. And as you can probably guess, his advice proved to be worth listening to, because 10 years later, in 2018, shares in JP Morgan had increased by about 240%, which is a great return. As an investor, especially a newbie investor, you might not feel completely comfortable about going on a stock market shopping spree when the market is in turmoil. But if you're investing for the long term and you've got cash sitting in your general investment account or in your ISA, then the wisest time to use some of it is when falling markets have brought prices down significantly for your favorite high quality funds or stocks. Method number 3, don't hold too much cash. So, like I touched on in the first 2 points, having cash on standby plays a valid role for any investor. You may well want to keep some cash handy as a war chest to invest when prices are low, or just to diversify your assets, especially if you store the cash in a high interest savings account. But remember that if your cash isn't actually in the stock market, that your money isn't working for you at its full potential. It may earn you some interest, but at the moment it's losing real value in the face of much higher inflation. It makes more sense to look at all your assets holistically and keep a separate cash cushion in an easy access account for an emergency fund or any big purchases you're expecting in the short term, such as a holiday or upgrading your car. That way, rather than having a large portion of your cash sitting and waiting on the sidelines, you can make the most of potential market opportunities that you'd otherwise just miss out on. Method number 4, reinvest everything. If you don't actually need to take an income from your investments, then please don't. Instead, get into the habit of reinvesting any earnings you make back into your portfolio if you can. If the temptation to withdraw returns just proves too much, then opt to have these automatically reinvested so you don't even see them in your account. This is what will happen if you select accumulation funds like Vanguard's VUAG ETF, for example, which tracks the S&P 500. Dividend reinvestment over the long term makes a huge difference to the performance of your investments, because those reinvested dividends are used to buy additional units or shares, which themselves then produce dividends that can be ploughed back in time and time again. For example, £10,000 invested in a FTSE 100 tracker at the start of 1986 would be worth 53,400 by the end of 2020. However, if those same dividends had been reinvested, the initial investment of £10,000 will be worth a very chunky £196,000. And that's the magic of compounding for you. It becomes increasingly significant as your investment grows over time. So it's really a big deal if you want your investment pot to support your retirement plans or any other long-term goals that you might have. Method number 5, rebalance your holdings. Over time, it's inevitable that some of your investments in your portfolio will be more successful than others. And as a result, account for an increasingly large proportion of your total portfolio. And it can be very tempting to simply hang on to the winners as they grow and just leave them be. While you might think if it ain't broke, then why try and fix it? But common wisdom says that it's sensible to review your portfolio regularly and trim your exposure to any fast-growing holdings you might have. You can also use the profits to top up on stocks that seem relatively undervalued. If you don't rebalance, then the danger is that over time, the fate of your portfolio as a whole becomes more and more dependent on the most successful holdings. And at the same time, there's a further danger that the holdings in question may become overvalued because of their continued success. When one of these holdings that you're relying on to support your portfolio subsequently falls out of favour, and that is bound to happen at some point, you'll have a much nastier shock than if you'd done some trimming at the beginning and kept it to a reasonable proportion of the whole portfolio. Method number 6, embrace risk. As a long-term investor, you're in a very privileged position because you can afford to look at your holdings in terms of decades rather than months or years. And that means you can invest in those parts of the market that offer higher potential returns over the long term, but with greater short-term risks attached. This is the case even if you're in your 50s and 60s. It's never too late to start working on your investment pot. Now, that's not to say you should funnel all your money into startups, emerging markets, or the next meme coin. However, you can afford a decent level of exposure depending on how much risk you can tolerate. And this will be at different levels for everyone. So work out what this is for you and commit to that strategy. Method number 7, diversify. Having a mix of assets within your portfolio really is sensible for any kind of investor. You should try and aim to diversify across geographical regions, market capitalizations, investment styles, asset classes, fund managers, even investment platforms as well if you can. If you're wanting some practical advice on how you can create a bit more diversification across different asset classes, then I'll link a video I did on this in the description below. But the argument is that focusing on just one type of investment leaves you dangerously exposed because things will inevitably go wrong eventually, and you're very unlikely to be able to time your exposure to markets to avoid them. It's therefore better not to try and instead simply spread your interests across a range of holdings that respond differently in different market conditions. If your investment account is well balanced, then it's likely that at any one time, some parts of it will be outperforming, even if others have sunk into a dark abyss. The goal is to try and minimize the ups and downs in your overall portfolio value, while at the same time achieving reliable returns overall. And a final way you can boost your investment returns is to reduce your fees. Just take a step back from the minutiae of your investment accounts and make sure you're not overpaying for the platforms you're using. All else being equal, the more that goes on fees, the less money you have being put to work in the stock market. There are brokers like Trading 212, Invest Engine, eToro, etc. that don't charge platform fee at all. Some platforms charge a percentage account fee that may be tiered or capped above a certain portfolio value, which means you might end up paying more over time as your portfolio grows in value. Other platforms operate on a flat fee basis. For portfolios worth more than £25,000 or so, a flat fee arrangement is generally cheaper as you'll pay the same account charge for a portfolio worth £30,000 or £30 million. There are also fees that might not be immediately obvious, such as withdrawal fees, foreign exchange fees, etc. So definitely keep an eye on these and make sure they're reasonable. Also, it's not just the platform charges that could eat into your profits. Look also at the costs attached to buying or selling investments, as well as ongoing charges or management fees for ETFs or actively managed funds. If you can't justify the cost of an investment, then it probably doesn't belong in your portfolio. Let me know in the comments if you've used any of these methods that we've talked about in your investing journey, or if you've got any other tips that might be useful, then please go ahead and share them in the comments below. That would be great. Thanks so much for watching. Please like the video if you got any value from it, and I will catch you in the next one.